It was a rough session for the U.S. stock market. While the S&P 500 was only down 0.42%, I can assure you it probably felt worse to most of you than that final outcome. And the reason is because 4 out of every 5 stocks was lower today. It was another one of those days where a handful of mega cap tech stocks kind of carried the market and prevented the losses from getting out of hand. But if you look underneath the hood, you saw major sell-offs in some key areas of the market, including the industrials, including consumer staples, many parts of financials and healthcare. All of the utilities were down today in the S&P 500. So it did not look healthy out there. We'll take a look at all of that, see what it means for our postures in those various sectors. We'll take a look at the sector selector in tonight's video. We'll also take a look at some key macro charts and show you that interest rates are surging once again. The dollar finds itself at multi-month highs. A lot going on here as we get started with this holiday shortened week. Then we'll get into our trading application example, and there I wanted to feature a rare bullish trade that emerged from today's session within the energy patch. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's September 5th, 2023. First of all, for those of you that are new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into the description area. Make sure you're signed up for our email distribution list. So that way you can be notified whenever we post these videos. You'll also see which stocks are giving you overbought and oversold cluster signals within the S&P 500 at the bottom of those emails. And with the recent selling, I imagine we'll probably have a lot of oversold cluster signals here in tonight's email. In addition to that, we're heavy users of X, formerly known as Twitter. My handle is @BrandonVanZ. We really appreciate those of you that click like and repost on these Market Outlook related posts. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And as you can see, I've got the S&P 500 heat map pulled up here in front of us. Now I'm using this on the FinViz website here, partly due to the difficulties of the Schwab and TD Ameritrade transfer that some of you might have been caught up with over the weekend. I was one of those. Where a couple of my accounts got transferred over to Schwab, but the others remained at TD Ameritrade. So now I'm kind of in this weird limbo position where, unfortunately, from what I can tell right now, you cannot log into a TD Ameritrade linked Thinkorswim platform at the same time that you log into a Schwab linked Thinkorswim platform. You have to do one or the other. You have to shut down one in order to get into the other. So with the account that I traditionally use my analysis for these Market Outlook videos is a different one than the one that I use the heat map for. So anyway, it's probably confusing for some of you that don't use that platform, but let's just say I've had a heck of a day trying to get organized after some of those issues surfaced here over the holiday weekend. So bear with me here, but it is nice that we have kind of this backup here on FinViz's website to kind of get us through any of these transition periods here on the Thinkorswim platform. Nonetheless, let's get into some of the information here. You can see that it was clearly a bearish day in the market. It wasn't even particularly close. In fact, we'll see some of the specific numbers here in a little bit, but we're talking about 4 out of every 5 stocks were down today, even though it wasn't a huge meltdown day in the overall stock market. And again, the reason is because of the Magnificent Seven. How many times have we heard that this year? You can see that, for instance, Tesla had a great day. It was up 4.7%. Meta was up 1.3%. Microsoft was up 1.5%. Even Apple managed to close higher on the day, just barely, and Nvidia closed higher on the day, just barely. So, right there you can see that 5 out of our Magnificent 7 closed in the green today, and the 2 that did not were Amazon, down by 0.61%, and Google, which was basically just flat. It was down 0.07%. So because Tesla and Microsoft and some of these others carry a lot more influence within the S&P 500, which is a market cap weighted index, it didn't make it look as though it was an awful day in the stock market if you were just to look at the the return of the S&P 500 today. But if you start looking underneath the hood and you look at it the way that we do here in these videos, you'll see it was a disastrous day for the vast majority of the market. I mean, this was a really bad day here. You can see that there were significant areas that were really out of favor. Utilities comes to mind here. Some of you might have seen my post there on X a moment ago about the gif of the cartoon guys shoveling the dollar bills into the furnace. I said that's what it kind of feels like to be a utility investor these days. Here's what I'm referring to. As I look at the regulated electric utilities, every single one of those stocks was down today. I mean, it was bad news. And then if you even go over here to the diversified utilities, they were all down. If you go to the renewable utilities, they were all down. If you go to the regulated utilities, they were all down. And even the water utilities were all down. So it was a clean sweep. Literally every single utility stock in the S&P 500 closed down today. And remember, usually the utilities are a very calm, quiet corner of the market, not really making a whole lot of waves. Well, that has not been the case in 2023. Those things have just been blasted. And it didn't get much better in other areas as well, including the industrials. Remember, the industrials have been kind of a silent hero of this market for much of 2023, but that has seemed to have changed here in the last, let's call it 2 or 3 weeks or so. They are now getting caught up in some pretty heavy selling as well. So this entire area that I'm kind of circling here are all of our industrial sectors with the individual industry groups within those areas. And you can see the vast majority of them in the red. There was a little bit of green there with the waste management. Copart was up a little bit there. But for the most part, this was a really ugly day for the industrials as well. And remember, that's a lot more important than the utilities. Utilities, of course, are important for income investors, but the sway of the industrials within the market is much more important than what you'll find out of most utilities from a market cap perspective, just a heft and an importance perspective. Industrials, are really up there with some of the better, sectors in that regard. In terms of some of the other areas that were out of favor, naturally on a day when the utilities are down, there's a pretty decent chance that the real estate investment trust, the REITs, will also be down. And you can see that was the case here today. Many of these pretty much out of favor. It wasn't a clean sweep of bearishness the way that it was with the utilities. You had a few that managed to close higher, like in the real estate services area, they were up a little bit, but the vast majority of REITs were down today as well. You found that a lot of the consumer staples were down. Costco managed to close a little bit in the green there. They're kind of an exception to the rule. The vast majority of all of these defensive consumer stocks were in the toilet once again. You had most of the financials out of favor, even including Berkshire Hathaway that had been on quite a nice run here in recent weeks and months. It was down today. All the banks, or most of the banks, were down. It was pretty aggressive selling there as well. Healthcare was a bit hit and miss, kind of interesting because while you didn't have a clean sweep of selling in healthcare, you had, United Healthcare and Humana and a few of those that were up. It was kind of interesting to see that those that were down pretty aggressively. RMD, this ResMed here, was down 3.33%. Baxter was down basically 4%. You saw Thermo Fisher down 2.7%. Illumina, that stock has been in the toilet here lately as well. It was down over 5% here today. You had some of these big drug manufacturers like Merck down 2%. You had Bristol Myers down 2%. Those are some pretty big moves for those giants of that particular area. And even in the medical devices, Medtronic was down over 2% here today as well. So, you had a little bit brighter red colors here in the healthcare, even though you also had some of the brighter green ones. So it was kind of a more of a barbell type of a day there in the healthcare area. In terms of areas that had a little bit more consistent green, there wasn't a lot. You could probably say that energy was one of the few. We'll actually be talking about an energy stock in our trade application example a little bit later on, but you did have a little bit more green in energy. And then it was kind of, spotty over in the technology area. they held up reasonably well, at least comparatively. You had a handful of these, semiconductor companies that did manage to close in the green, and you also had software companies, closing in the green there. So, if it wasn't for technology and energy, things would look quite disastrous. It was already a bad day. I mean, you do not want to see this kind of a heat map when you kind of roll into this holiday shortened week like we have, especially in a month like September, where we already know that there's a little bit more nerves in the air around the stock market in this particular month as well. So a pretty bad day, if I might say so myself, for the vast majority of the market, and it's being somewhat cloaked by the fact that you had some mega caps that had a little bit of outperformance here today. Let's take a look at the specific numbers now. And you can see that when I pull up the S&P 500 on our index watch here, that 88 out of the 500 companies closed in the green here today. So that was good for only about 18% of the market that closed in the green. So again, 1 out of every 5 stocks closed in the green, 4 out of every 5 stocks closed down here today. That sounds like a terrible day, right? That's a overwhelming bearish day. And then you look at the end result, and the S&P 500 was down just 0.42%. That's it. It wasn't even down 0.5%. With that terrible of breadth, it did not even close lower by 0.5%. So again, thank you to Tesla and Microsoft and a few of those others for carrying their weight here today. But definitely not a good day out there. I think most of you, if you're looking at the various positions you might have in your account, you're probably going to find that way more of your stocks were down than up today. And it might be a little surprisingly so, considering that it was only a 0.4% down day for the S&P 500 as a whole. Let's go through where things stand from a posture perspective now. Remember, for those of you that are perhaps newer to this video, that this main view that we look at here is going to include a technical indicator called the market forecast technical indicator. Some of you that have been with David and I long enough may recall that when we worked for TD Ameritrade all those years ago, we used to do a similar video to this called the market forecast video. Once we started up over here at Market Scholars, we had to change the name of that to the market outlook video, but it still kind of drives what it is that we teach within this video here. The market forecast technical indicator is still very important to what it is that we analyze during these videos. So it is an indicator that works like a stochastic over multiple time periods, and it is available on TD Ameritrade and now the Schwab Thinkorswim platform, supposedly. So some of you may have access to it. Those of you that might have accounts at Fidelity or Vanguard or what have you, you probably don't, but you still get the benefit of listening to our analysis about it anyway. But as you can see, the S&P 500 does still have that dark green background color on our chart here. And that signifies that we still have a strongly bullish posture using the intermediate line on that market forecast technical indicator. That intermediate line is also this green line that you see down below. So sometimes you might hear me call it the green line. Sometimes you might hear me call it the intermediate line. They are one and the same. And you can see in the label here that that intermediate line is at 63 and rising. So since it's above the 50th percentile, we would consider that a little bit more strongly bullish in that case, as opposed to the way that it was like a week ago when it was just kind of getting up and off the mat there. The nice thing about the S&P 500 right now is that it is above its 30-day moving average. However, that color of the moving average, you'll notice here where I'm circling, is yellow. And what that constitutes in this case is a little bit of conflict. On one hand, we have strength in price because price is above a moving average. On the other hand, the moving average, which is a lagging indicator, is still going lower. So strength and weakness combined for what is basically a neutral color of yellow. Think about a stoplight there, where green would be considered good, like back here. Red is considered bad or stop, and then yellow is kind of that yield territory where we're awaiting further information. So that's kind of how things stand right now from that particular perspective, looking at the 30-day moving average. You'll also notice that despite a pretty nice push higher in the S&P 500 over the last week and a half, we have yet to get up and over this prior high from July 27th. And so that may be a little bit concerning there as well. Perhaps setting up the possibility of a bit of a double top over that time period. So we'll see where things go from here. But again, not a very good day. This actually, even though we closed basically at the low of the day, which normally I'm not going to be too joyous over, this could have been so much worse. I mean, I'm sure if we look at the RSP, that might be a good idea here. Remember, SPX is going to be the market cap weighted index, but there is an ETF that tracks the equal weighted index out there. And that's RSP. I haven't looked at it yet, but I'm sure once I pull it up, it's going to make it look a lot worse. And it does. Look at how dramatically worse it is. It's not even close. It's down 1.24% today. So for those of you that aren't familiar with RSP and this concept of equal weighting, it would be like taking the 500 stocks in the S&P 500 and applying the exact same weighting to each of those 500 companies. The normal S&P 500 that everybody looks at is market cap weighted, meaning that Apple and Microsoft are way more influential on the end result than very small companies that are in the S&P 500. This equalizes everything. So from a breadth perspective, you can see how bad it should have been for the S&P 500 today. It should have been a day where it was down over 1%, just like RSP was. But instead, you go back over here to SPX, and it looks like it was only down 0.42%. So that is a tremendous difference. Remember, a lot of the days, you're not going to see a huge difference between those two numbers. Today was a dramatic difference between those two numbers. In terms of the Dow Jones now, you can see here, it was down a little bit more than the S&P 500. Remember, the Dow Jones is a price-weighted index, so it's calculated even more differently than the other two methods I just mentioned a moment ago. So in this particular case, the higher the price of the security in the Dow Jones, the more influence it has on the overall end result of the Dow Jones. So you have companies like United Healthcare, as an example, that are some of the higher ones, higher priced ones out there that will have a bigger influence within the Dow compared to something like Cisco Systems, which has a relatively small dollar value. So it's kind of interesting in that regard. It doesn't matter about the market cap at all. It depends upon the price per share. Anyway, Dow was down more than the S&P 500 today, down 0.56%. And as you can see from the price activity here, it's really struggling to get through this moving average. We talked about that when I was with you last on Thursday. I'm sure David talked with you about that over the weekend with his video as well. And it's just giving you the impression that it's using the underside of that falling 30-day moving average as resistance and is trying to bounce down and away from it. It's not a great look there. Now, having said that, the green line is still, by the slimmest of margins, considered to be weakly bullish. Note that it's not strongly bullish like the S&P 500, and I think that's fair, right? S&P 500 is still above the moving average. In this case, the Dow Jones is clearly below it. So I think the Dow deserves to be viewed more poorly than the S&P 500 at the moment. And it could be as soon as tomorrow, in fact, a very good chance that tomorrow the Dow has its posture go back to strongly bearish like it was here with that darker shade of pink. And the reason I say that is you can see just visually here, that green line looks about as flat as a pancake. So remember, if it even goes down just by a skosh, that will change the background color to that dark pink once again. So if we have another day of selling tomorrow, I'm going to assume the Dow Jones will be back to strongly bearish. You'll see that the moving average color is red, so that makes it different than this yellow line over here on the S&P 500. The reason it's red for the Dow is because price is below the falling 30-day moving average on this one. The S&P 500 price is above the falling 30-day moving average. So clearly the Dow looks worse from all of those vantage points than what we're seeing out of the S&P 500 at the moment, partly due to the fact that, Tesla is a big part of the S&P 500, but it is not in the Dow, right? So and you could say the same thing with NVIDIA and a handful of those other Magnificent Seven stocks. So that seems to be the difference in this case. Onto the two bottom charts now. Lower left-hand corner, you have your NASDAQ composite. It was the one that held up the best. And, given what we saw on the heat map, that should not surprise us as, a stock like Tesla and Microsoft and, those types of companies are going to have a bigger influence in the, technology-heavy NASDAQ composite, which is also a market cap weighted index where something like Apple is going to have a lot more of an effect than a smaller company. And so anyway, you can see here, barely budged at all today, down just 0.08%, so nearly flat performance for the NASDAQ composite on a day when the equal weighted S&P 500 was down over 1%. So that is quite the tremendous difference. Similar to the market cap weighted S&P 500, you have that potential for a bit of a double top here, as we have not yet exceeded the highs from back here in July. And at this moment, the moving average is still going lower with price above it, similar to the S&P 500. So that's why both of them have that yellow moving average at the time. And you can see that the posture remains strongly bullish at this moment, with the green intermediate line trending higher here towards the upper reversal zone. Notice it's at 68 in terms of the official reading right now, which is higher than the 63 at the S&P 500. So you could get away with saying that the NASDAQ has become the leader of this market here more recently. And then on to the Russell 2000 in the lower right-hand corner. You can see they really took it on the chin today. Russell 2000 was down 2% today. That is a huge difference than the flat performance of the NASDAQ composite. Again, you rarely see those types of deviation types of days like we saw here today. So it really depended on, did you have mega cap tech in your index? If you did, then you might have been able to withstand the storm somewhat reasonably well. If you didn't have any mega cap tech within your portfolio or within the index that you track, then it probably got hit pretty hard today. And that was the case with the Russell 2000. Remember, none of the Magnificent Seven are part of the Russell 2000. That's what makes it the small cap universe, and those are mega caps, of course. So they didn't have any of the support of the Teslas of the world, and that's why it was just more of a free fall for the Russell 2000. And I would say the same thing that I had mentioned about the Dow Jones Industrial Average. This is not a good look for the chart, right? You had this push, a reversion to the mean type of a move higher over the last week and a half for both of these indices off to the right-hand side. Both of them made it a good old college try, so to speak, to make a push higher, but they both faced resistance exactly at the downward trending 30-day moving average. And so it gives us the impression currently like that is being used as resistance right now, and the sellers are willing to let go of their shares at those prices. And that's not what you want to see if you want to be bullish on these areas of the market itself. So not a good look there to be rejected so aggressively at the downward trending 30-day moving average to the tune of a 2% meltdown here today in this index on the same day where you had basically flat performance in mega cap tech world. You'll notice that the moving average, of course, is red the same way that it was here with the Dow Jones Industrial Average, telling us that price is below a falling 30-day moving average. And then you can see here that the background color is this light green color, telling us that we have a weekly bullish posture, not strongly bullish like on the S&P 500 and the NASDAQ, but it still at this moment is retaining that weekly bullish posture, but somewhat similar to the Dow Jones. It looks a little flattish. I think the Dow is at the biggest risk of rolling over. So despite it having a 46 in the intermediate reading and the Russell 2000 at just 40, the slope of the line looks like it is more likely that the Dow is going to go to a bearish posture before the Russell 2000. They might happen on the same day, but if it is a case where one goes first and then the other one comes a day or two later, from what I can tell right now, it looks like it's going to be the Dow that goes first and the Russell 2000 may be just a day or so after that. Because today is still a day where you have at least weekly bullish postures on all four of these charts, and it was a day of selling for most of these indices, you did end up having what's known as a bullish intermediate confirmation signal that occurred on the S&P 500, on the Dow Jones Industrial Average, and the Russell 2000. Remember, those occur when you have a bullish intermediate line on the same day that you have the red momentum line in the lower reversal zone. And so that was the case on 3 out of these 4 charts here today. However, before we get too excited about the prospects of that signal, remember there are ways for us to try to identify which signals are better or worse. And in today's case, I would say the signals are worse because we do have extreme moves in the momentum line. Remember, we usually qualify an extreme move in the momentum line as being under 5.0. Well, if you look at these labels, the S&P 500 is at 1.72, the Dow Jones is at 1.46, and the Russell 2000 literally at 0. Remember, it doesn't go below 0, so this is literally the worst you will ever see, that red line. That's how extreme it is, and it only happened because you basically had an extremely wide candle from high to low today, and you literally closed at the low of the session, right? You look at this candle here, and it is completely filled in red, and basically telling you closed at the lows of the day. And since the market forecast is similar to stochastic, that's how it's going to measure that. So anyway, yes, you have the bullish intermediate confirmation signals, but none of them are considered of the ideal variety. They've got some holes in them, and you've got to tread a little bit more cautiously as a result. Let's take a quick peek here at our 3 green arrows charts, which are probably closer to 3 red arrows, but nonetheless, let's pull them up here. And as it stands right now, we actually don't have any 3 red arrows, so I'm glad I checked this because I would have guessed that maybe we would have on a couple of them. But at this moment, we have the 2 charts on the left, which we knew were stronger, the S&P 500 and the NASDAQ Composite, retaining their 3 green arrow strategy at the moment. But the 2 charts on the right, where I thought maybe we might get a 3 red arrows, we haven't quite gotten there yet. Both of them have red arrows in play, but neither of the 2 have all 3 of the indicators with red arrows here at the moment. So we'll keep our eye on that. If that changes in the future, we can do our best to let you know on that. And then let's also take a look at the longer term charts here, the 1040 crossover method charts. Remember, on these charts, which is chart 4C, for those of you following along at home with your own charting package, these are longer term charts. And so each one of these 4 charts will be 3 years in length, and each one of the candles you see will represent 1 week. So they're not daily candles. And in this case, you can see that we have retained our bullish or golden crosses on all 4 of these charts, but it is getting sketchier as time goes on. The one that is looking like it could flip to a death cross the fastest is the Russell 2000. So like if I were to right click on this chart down here, you can see that these 2 lines, the orange line and the blue line, are pinching together a bit more. Remember, the orange line in this case, where we're looking at a 3-year weekly candle chart, this is a 10-week moving average, that orange line is, and then the blue line is a 40-week moving average. So for those of you that are using daily charts, you might be using a similar thing with a 50-day moving average as the orange line and a 200-day moving average as the blue line, but they're effectively telling us the same thing. Anyway, you can see here where it stands right now, these 2 charts, or these 2 lines, I should say, the 2 moving averages, are the tightest of the other charts that we were looking at. So like if we were to look at the NASDAQ Composite to show you an example of the opposite, notice how much difference there is between this orange and this blue line. It is a massive difference. And then we look at the Russell 2000, and it's nice and tight in there. So it gives us the sense that if there is going to be a death cross, it's going to happen on the Russell 2000 first. And then we will see that background color of this chart go to pink when that happens, just like it did over here where that orange line went down and below the blue line, the background color went to pink at that time. So we're still a ways away from that. I don't want to make it seem like that's imminent, but the point that I'm trying to make is, of the 4 major indices that we track, it does appear to my eye like the Russell 2000 is going to be the first one to go back to a bearish crossover, if that is going to be in the cards for these, right? If we had some sort of a massive rally starting tomorrow, maybe we get saved by the bell and none of these have to go that way. But if we are eventually going to have bearish crossovers take place on these charts, I'm going to guess that it's the Russell 2000 that will be the leading one that takes us there first. Let's pop on over here to the internet for a moment. I always like to get a chance to say thank you to those of you that help support these free presentations that you do find here on YouTube. And as I always say, as long as we're up and over 100 likes, I'm more than happy to do an hour-long presentation for you. If we're under 100 likes and people aren't getting quite as much value out of these as they might have used to in the past, or they just prefer a shorter length video, then don't click like, because if we're under 100 likes, then I'll just try to keep it to 15 minutes only. So we'll let you guys decide collectively on that. But the last time around on Thursday, you guys got me up and over 100 likes despite me wearing my Rams gear that day. It's going to be a challenging year for my Rams if we can't get Cooper Kupp in a healthy position. So anyway, appreciate the support to all 102 of you. Let's do some shout outs to those who are helping us along. Thank you to Lucius. Thank you to Carl. Thank you to Eugene. He's a Los Angeles guy, so he might support my Rams gear there. Thank you to Ron. Thank you to Serene. Thank you to John, and to Robert, and to Michael, and to Pam, and to Irene, and Jane, and Ken, and Jeff, and Sherry, and Dividend Blasters on YouTube. Thanks for the shout out today, by the way. I saw your Twitter circle there. I was proud to be part of that, so keep up the great work on your end as well. Thank you to T-Fib, and to Larry, and to Dividend Freedom, and to Randy, and Yechiel, and Tobias, and Dave, and George, and Paul, and Scott, and Paul, and Arthur, and Ann, and Ray. Too many to get through all of you, but every so often I hope you hear your name get called out, because I just want you to know that I appreciate you. Thank you for taking the 5 seconds out of your day to help us with getting the word out about these videos, as they do take up a considerable part of our time to do for free. And I think most of you recognize that and want to help support us. So thank you to those of you who do that regularly. Let's have a chat here now about the Sector Selector. So just as a heads up, I did produce the Sector Selector last week before I had my little weekend trip over there to Sun Valley. Some of you might have seen the pictures I posted there on Twitter/X of, they have a really interesting parade that they do on Labor Day weekend there, where it's one of the longest running non-motorized parades. So everything in the parade is like donkeys and horses. They even had camels. Everything was pulling like covered wagons. It was pretty interesting. So we had enjoyed our time there. Saw some of the sites and the ski resorts and all that kind of stuff. So a nice little part of the world to get away and kind of enjoy some outdoor activity before the summer comes crashing to a halt. Some of you saw my post on Twitter earlier today that one of the ski resorts here where I live in Utah, Snowbird, which is where I go up for Oktoberfest every year with some of my buddies. Anyway, they already got their first snow this weekend, so I'm not sure I'm ready for that yet. But maybe some of you are. I'm not much of a skier myself, but yes, the summer is winding down in a big way. So anyway, I was out of town this past weekend, but before I left, I was still able to produce this Sector Selector and get it posted to our site. But a reminder that it is a couple of days old at this point. It was produced on September 1st, so it can still give us a pretty good idea as far as any sort of rotations that are taking place. And remember, one of the interesting things about this Sector Selector is it's based upon an equal weighted approach, not a market cap weighted approach. So it equalizes the impact that something like an Apple or a Microsoft might have. And that's kind of an interesting thing to be aware of here in this particular sense as well, because you can see that information technology did go up from number 3 to number 2 week over week. And so some of you might be thinking, well, is that mega cap tech exposure that I was mentioning before? And you can't say that it's not, because technically that's part of it, but it's not the whole story. So I think that's important to note there as well. Yes, it's true that Microsoft and Apple and Nvidia are doing pretty well, but it's not like they are the only ones within the technology sector that are doing that. There are still plenty of other technology stocks, even smaller ones, that are holding up better on a relative basis than the smaller companies in most of the other sectors that are out there. Energy, by the way, remains at the top for the 5th straight week. As I mentioned here earlier, we will be doing a trade application example here in tonight's video from the energy patch. Industrials did slip, so going back to my comments there during the heat map, where I've noticed some slippage in the industrials strength here in the last couple of weeks. That is case in point, right? It's starting to show up in some of our rankings at the moment as well. Consumer discretionary and materials both made a move up, effectively just replacing communication services. Part of that, I wonder, is what's going on in the media world. Some of you have been following the saga with Disney and Spectrum and some of these other, things going on with programming here lately. And of course, Disney has been in the house of pain. And so remember, this communication services, because it is equal weighted, it's not going to have an outsized impact with a stock like Meta or like Alphabet, like you would find in the market cap weighted version. So the smaller media companies are going to have a bigger role here in this sense of the communication. So I think that's part of the reason you saw a little bit of slippage there. Some of those media names really taking it across the chin last week. We did see REITs fall quite a bit. That's not a surprise given the fact that the utilities have not been able to get off of the bottom two positions during this entire 3 months, right? If you look at the utilities, which is the yellow line here, and you backtrack with it throughout the prior 3 months, the best position it's had is 10th, the worst position is 11th. So it stayed at either 10 or 11 the entire time. Real estate's kind of been all over the place, but in general, remember, REITs and utilities tend to be tied together because they're both viewed as being very interest rate sensitive sectors. They're kind of like bond-like proxies. And so no surprise, at least to me, that real estate came back down to utilities as opposed to the opposite. And then consumer staples does remain dead last here. So it's been, let's just say, challenging, to put it mildly, in the dividend space here lately, with real estate, utilities, and consumer staples all down there at the bottom. This has not been an easy time period for those companies that did so much better last year. This is a moment where it is the big semiconductor companies like NVIDIA that are having their time in the sun. And a lot of these older school, more mature businesses are really struggling on a relative basis right now. And that could very well mean that there's opportunities for those of you thinking longer term, right? This particular video that I'm in the midst of right now does cater more to a short-term trader, but certainly some of you probably have longer-term accounts out there as well. And if you do, then I think there's probably some very interesting opportunities that are emerging here within some of these areas. And of course, if you need some assistance with that, I do teach a class every single week called Dividend Growth Investing. In fact, I just taught it this morning, and for those of you that are looking for the recording, it is now posted on the Trading Rooms tab there. Of course, you do need to be a member of Market Scholars in order to access that. Let's also have a quick little chat about a couple of these resources that I posted on the Dividend Growth Investing blog. So a moment ago, I said that in order to watch my classes, that's a premium experience there. And so you would need to be either a plus or premium member of Market Scholars to access my classes. But I do have a couple of posts that I do make available for free on our website, even if you're not a premium member of our organization. And so for those of you just getting started in the world of dividend growth investing, I would encourage you to go to marketscholars.com, and then once you're there, hover your mouse over the blog portion of the mega menu and then click on dividend growth investing. Once you do that, you'll see a couple of posts that I put together here over the last weekend. One of them is this one called Dividend Growth Investing Increases from August 2023, and that's going to show you all those companies that increased their dividends last month. These are companies, by the way, that have at least 5 years in a row of increases prior to this. So this would not include a company that just started paying a dividend last year or something like that. And some of these, of course, have long histories of paying dividend. American States Water is actually the granddaddy of them all from a streak perspective. 69 years in a row now for American States Water of increases every year for 69 years in a row. And Dover's not that far behind it. Dover's at 68 years in a row. Nordson, another aristocrat, is 60 years in a row. Federal Realty, a real estate investment trust, is 56 years in a row. Of course, most of you know Altria, the company behind the Marlboro cigarette, 54 years in a row. So anyway, feel free to dig into some of these details if you want to go into that on your own time. It is available for free for everyone, as is this other post that I also put together at the ends of the month, or the beginning of the month would maybe be a better way to phrase it. But anyway, this is the dividend stair-step sector statistics. For those of you that are premium members, I did give my analysis on this in today's dividend growth investing class, in addition to the traditional head-to-head matchups that we do in that class. But just real quick, what I would point out to this free audience here in the video tonight is that when you're reading this, just a quick and dirty of how you would read this is blue is what we would consider to be undervalued stocks, and orange would be overvalued stocks according to the dividend yield theory based upon that dividend stair-step chart that sometimes you guys see me posting about on Twitter. So anyway, right now, 43% of the approximate 700 companies in our DGI universe are considered to be undervalued where their current dividend yield is based upon their history over the past 10 years. 17% are considered overvalued. So 43% undervalued, 17% overvalued, 39% considered neutral, neither overvalued or undervalued. So this number, you might be wondering, well, is that big? Is that small? This is a big number. It's not the biggest number we've seen or the highest number, however you want to say that, but it is up there towards the highest amount that you will see in terms of stocks that are considered undervalued. And like I've been trying to stress when we've had this conversation in recent months as well, because this has been kind of an ongoing thing in 2023, what's unique about it is, of course, we're not all that far away from 52-week highs in the S&P 500. I think a lot of people are saying, oh, things are going just fine out there. You know, prices are grinding higher and this, that, and the other thing because they're just looking at the Wall Street Journal. Well, if you actually dig into the data underneath the surface, there are a lot of areas, specifically the dividend-oriented areas, that are really out of favor right now price-wise, which of course then means that their dividend yields are higher than average right now. So depending upon where you're looking, you might have a different takeaway as to whether this is a strong market or a weak market. But, to put a ribbon on it, so to speak, just be aware that if you are looking for opportunities as a long-term dividend growth investor, there are lots of good opportunities out there. And I would cite that the financials, the utilities, the REITs, and the staples, I think all four of those areas offer really interesting choices here at the current moment. All right, let's go ahead and now pop on over here to the platform and start our 12 grid analysis, starting with chart 5A. And so a reminder when these charts pull up here that the background colors of these charts will tell us what the market forecast technical indicators posture is on these different charts based upon that intermediate line that I referenced before. You can't actually see the intermediate line unless you right click on the chart. So like if I were to come down here and look at the TNX and I right clicked on it and went to maximize sell, then you can actually see that green line down below. And it's probably a good place to get started with our analysis because there was a change here today. Remember just on Thursday when I told you not to count out the 10-year Treasury yield as much as I wanted to, because again, I would prefer to see yields going lower. It would help my accounts tremendously if that were the case. So if I wanted to be a cheerleader for anything, if I were trying to talk my book, I would want it to go lower. But I told you on Thursday, don't hold your breath. Until we see a significant break below that 30-day moving average, I'm going to assume that we are in kind of one of these higher for longer moments when it comes to interest rates. And look at what's happened just the last two sessions. So this one would have been Friday, and then this would have been today. A huge bounce up and off of that moving average, followed by another huge bounce here today. And all of a sudden, the 10-year Treasury yield is at 4.26% once again, and not all that far away from multi-month highs. So that was enough of a bounce in the last 2 days to basically pull this green intermediate line up as well. Because remember, when I was with you on Thursday, the background color was that light shade of pink. But because we've had 2 really strong days since I was last with you, that has now changed from pink to dark green because it's been a sizable enough bounce to actually pull that and bend that intermediate line up with it. So anyway, that continues to look like a really strong chart. I've mentioned this many times this year because it continues to be true, but just for a moment, pretend that this did not say TNX in this chart, and instead it said the ticker symbol of your favorite growth stock. When you looked at this chart, you would be salivating, and this has been happening over and over and over again. Every so often, it looks like interest rates are going to finally start peeling back, and we will unwind this trend, but it just simply has not been in the cards yet. Every time we get down to that moving average, buyers step in and use it as an excuse to push yields higher once again. So we'll keep our eye on it. At some point it'll change, right? Whether it's this year or not, who knows? But at some point, I'm sure we'll break that moving average. But as you can see here in the last 3 months, it has been just a powerhouse to the upside. In fact, I think it's been more than 3 months. So if I went here and went to, let's do a 6-month view instead, you can see that really since around here, the middle of May, is when it started to click into that nice uptrend that we're in the midst of here at this moment. So it's been more along the lines of a 4-month trajectory higher of higher highs and higher lows, not just the 3 that we see on the traditional view there. Let me go back over here. Some of my settings are still horsed up from this transferred to Schwab that happened over the weekend. So thanks for bearing with me here. There we go. So remember, when interest rates are going up, as they have been the last couple of days, the assumption is that bond prices will be going down, and that's exactly what we saw. Notice that TLT, which tracks the long-term U.S. government bonds, was down significantly the last 2 days. Notice how it touched the moving average here on Thursday, and then on Friday it completely fell apart, and then it had another day of completely falling apart here today, and all of a sudden we're close to multi-month lows, right? Just like that. So we had all this reversion to the mean type of the stuff off of these oversold cluster signals, and it failed. And what do I tell you guys regularly in this presentation? I assume that the reversion to the mean moves will fail. They won't every single instance, but I need it to prove it to me. So my assumption when I see something like this is that it will fail, and that's exactly what has happened here so far. Things could change, but right now I don't like the looks of what we're seeing out of TLT. It looks clearly like the path of least resistance continues to be to the downside, lower highs and lower lows. You can see we now have that strongly bearish posture with that darker shade of pink back there, in addition to, of course, the red moving average telling us prices back below a falling moving average. The other 2 bond categories also suffered today, not nearly as much as long-term U.S. Treasuries, probably not as much duration risk there, but nonetheless still sizable pullback days for those 2 entities as well. Foreign bonds were down 0.62%. You can see that was a pretty aggressive candle, and really this doesn't even tell the whole story, because part of this 0.62% move today was a gap. So you have this gap between the last 2 candles, and once it was open, then it continued to sell off even further throughout the normal session and closed near the low of the day. And then high yield bonds, you can see, were down 0.65% today, so somewhat similar to foreign bonds. But again, notice that it was an important day because we crossed straight through that 30-day moving average. It did not use it as an excuse for the buyers to step in and support the price. This was more of a head fake fluke to the upside, if anything, and now it's clicking back into kind of its more downward trajectory. At least that is if you believe the 30-day moving average, which is pointing lower at this point. I think you could also get away with calling high yield bonds more of kind of a neutral sideways type of a chop action, but I think there's a little bit more of a tilt on the foreign bonds, right? That still looks more like the path of least resistance is to the downside on foreign bonds. I think high yield bonds, you got a chance to try to change the trend eventually. And maybe part of that is because oil prices remain strong. Remember, a lot of the junk bond issuers come from the oil patch. And therefore, when oil prices are strong, as they were today, that's offsetting some of the weakness that you might have had in some of the other corporate issuers within the junk bond market. So anyway, all 3 of the bond categories back to bearish postures. All 3 of them have red 30-day moving averages as well. In terms of the U.S. dollar in the lower left-hand corner, so David was posting some things on Twitter about the U.S. dollar here today, so I know he's aware of this, and many of you are probably as well, but we broke out to multi-month highs here on the dollar today. It's been kind of more volatile lately, right? We had this weird day over here where you had a big sell-off, but then you had a kind of a follow-up day here yesterday where it completely reverted that. And now all of a sudden we broke out to the upside. So it's kind of been trying to shake the weak hands out of the trade, but without a doubt, the path of least resistance remained to the upside. And remember, this moving average stayed green the entire time during that choppiness, and the posture stayed mostly bullish during that entire time period as well. When the dollar is strong, as it is right now, you have a greater chance that you're going to have weakness in the foreign markets and in commodities. When it comes to foreign stocks, they did underperform the S&P 500 today. Again, they didn't underperform the equal-weighted S&P 500, but they did underperform the more traditional market cap-weighted version of it by about double. You saw that the developed foreign stocks, EFA, was down 0.87% today. Speaking of 87, I'm in football mode now, so I was looking at Travis Kelce here. Apparently he was in the news for all the wrong reasons today with an injury, but of course he's a famous athlete that wears 87. So EFA was down 0.87 here today, and you can see that it's got some of those features that I was referencing on other charts that I don't like, which is a rejection at that downward trending 30-day moving average. This is actually the fourth day in a row to the downside for EFA, and notice that the moving average color stayed red like the Kansas City Chiefs that entire time right there. EEM, which is the emerging foreign stocks, had a nearly equally as bad of a day, down 0.81%, but their chart maybe doesn't look quite as aggressive. Notice the background color here is light green, so we still have that weekly bullish posture, but it's still kind of giving you that impression that it's struggling to get through its 30-day moving average here. It might not have rejected it as aggressively as you saw with EFA. Nonetheless, it's not really making the impression that it wants to get through the moving average either. It's just kind of stalling out just a little bit below there. Down below, gold was down today with that strength in the dollar. It was down 0.82%. I don't think this is a very good looking chart at the moment, despite the green background color. You know, prices back below a falling moving average again. It wanted to get up and through there and break that downward trend, but it still has not proven that to us yet, despite its best efforts. So clearly we had a reversion to the mean move after those oversold cluster signals, but it's still not giving us the impression that it actually wants to change to be in an uptrend moving forward. Right now, if you were a betting person, it's probably still odds are that you're in a downtrend in gold. And then I mentioned before, oil managed to actually squeak out a win here today. There's a lot more kind of headline news going on with oil when you talk about Russia, Ukraine, and some of the things with the BRICS Plus that took place here recently with some of those Middle East nations joining with Brazil and Russia and India and China and those. So maybe they're going to have a little bit more power as a result of them being a lot of the oil states that are out there. Who knows? We'll keep our eye on that story. But anyway, whatever the reason, oil has been able to vastly outperform gold here more recently. And you can see that oil is now up here at multi-month highs here all of a sudden. And this is actually their 5th day in a row to the upside for oil. So it has been working very, very nicely. Something that hasn't been working very nicely, let's talk about Bitcoin. Bitcoin, after having that one huge surge there, then completely reversed that just 2 days later, and now all of a sudden we're on the brink of breaking down to multi-month lows. We're not quite there. We're still not quite to the lows where we were in mid-June, but we're within spitting distance. I mean, it could happen any day if there's any bit of selling that takes place there on Bitcoin. You do have oversold cluster signals, so maybe you get a reversion to the mean, move back higher in the short term, but the path of least resistance on Bitcoin, to my eye, still appears to be the downside here at the moment. Bitcoin finds itself just a hair below 26,000 at the moment. And then in the upper right-hand corner, we have preferred stocks. Don't get as much press as some of these other asset classes. Nonetheless, it stands out to me today simply because it looks like so many of these other charts that I mentioned that have resistance at that downward trending 30-day moving average. So not exactly what you want to see. Again, you've got that oversold cluster signal, reversion to the mean, struggling at that downward trending 30-day moving average, now giving us the impression that the sellers are stepping in here once again. So a lot of the charts are setting up that way, and I don't think that's a good thing for the market, broadly speaking. Let's go ahead and now take a look here at our sectors. This will be chart 5C for those of you that are following along at home. And, you kind of have a case of the haves and the have-nots right now in the sector land. And remember, these are the market cap weighted sectors here. You have your bottom rung, which are all of our defensive sectors that are really out of favor. Healthcare, staples, utilities, and real estate all have that dark shade pink background color telling us that we have strongly bearish postures from an intermediate perspective on them right now. Joining them, somewhat interestingly, is the industrials. And again, it wasn't my eyes playing tricks on me when we were looking at that heat map. I can see now clearly that the industrials really struggled today. They were down 1.68%. And look at what that candle looks like on the industrials. That is a massive rejection at that downward trending 30-day moving average. So are you trading way below the moving average like you are on staples or utilities? No. But in a way, that's almost a scary thing, right? The staples and the utilities have been so out of favor this year that you would like to think at some point they're going to reach some sort of a equilibrium or an area where value investors will step in and support the price. But kind of the scary thing about industrials is that had been one of our leading sectors of the year. So if it starts unwinding to the downside, it's got a lot more room to fall, is one way you could kind of interpret that. So, I hope that doesn't happen, but just, planting that potential seed there for you. So keep that in the back of your mind. With the staples and the utilities, you'll notice that both of them have those little green dots showing up underneath their candles for today, telling us that we now once again have oversold cluster signals. And the other ones haven't really amounted to much in the way of bounces, but there's been a little bit of oomph, like right over here. The staples got maybe a week of a bounce after that and then rolled over. And then with these ones on the utilities, same thing. You had about a week of a move and then rolled over once again. So could we be due for another mini push higher in those? Yes, but again, like I mentioned on the other charts here a moment ago, my assumption, until I see otherwise with my own two eyes, is that the downtrends will hold, even though I do think there is more value opportunities in staples and utilities for the long term. I have to actually see with my own eyes in the short term a reversal of the trend. Until I do, I'm going to assume that even if we get a reversion to the mean type of a move, it will be short-lived and we'll still be stuck in those downtrends. So just be prepared for that possibility there. You can see real estate bouncing down and away from its falling moving average there as well, kind of matching what I had identified with the falling real estate ranking in the sector selector that I showed you guys here earlier as well. The worst sector today, by the way, was actually materials. They were down slightly more than the industrials. They were down 1.85%. But you still have that light green background color there, at least for another day. I don't think it's going to last long, but for at least one moment, they still have the weekly bullish posture. In terms of those that did well today, the technology sector was up 0.36% today. Remember what I'd mentioned before, if we're looking for green on the heat map, I'd say it's probably either technology and or energy. So no surprise that those were the two that led us higher today. Technology up 0.36% today. Energy was actually the best, up 0.53% today and breaking some multi-month highs. And that's a good segue for our trade application example conversation here. As I mentioned a couple of times already in tonight's video, it is going to come from the energy patch. And so you can see why, if you're looking for bullish opportunities out there based upon technical analysis, this chart on energy looks a lot more like a friendly position for trending investments than most of these other sector charts out there. So let me explain what it was that I was looking at. Remember that I already sent out the notifications to those of you that are premium members via Telegram earlier today when the stock market was still open. But the stock in question is what they refer to as King Hal, ticker symbol HAL. This is Halliburton. Of course, some folks might remember it from the old Dick Cheney days. Vice president here in the United States had a role with the Halliburton company, but they remain a power player in the energy services world, them and Schlumberger, or I guess they call it SLB these days. But Halliburton's still a very, very important player globally. And you can see they're having a really nice bounce here the last couple of days, on the verge of breaking out up and over this little area right here. So anyway, wanted to do another bullish trade here since we had done some bearish ones recently with Starbucks and AbbVie and some of those. So in this case, wanted to kind of balance the scales a little bit, look at a bullish trade, and I think we have at least some evidence on the board in front of us on a day that was terrible for the stock market in general, where 4 out of 5 stocks were down. Halliburton looked like it was just marching to its own beat here, making a really sizable move higher, closing near the highs of the day, not quite exactly at it, but near the highs of the day. And you can see that the blue line is now in the upper reversal zone. You actually have the green line trending higher, so it would be considered strongly bullish at the moment as well. You can see it's easily outperforming the S&P 500 over the last 3 months, and you can see it's strong in multiple time periods with green labels across the board up at the top as opposed to any red labels sneaking in there. So what I did here today was what's known as a bull call spread, so buying a bull call spread, where I bought the 40 strike and I sold the 41 strike. When I did the trade, the stock was trading at around $40.50. So it was kind of a 1-for-1 reward risk ratio there. As the day progressed, or the final bell ticked, it did rise another 20 cents there. But basically what I'm hoping for in that case is for Halliburton to be trading above 41 on expiration day there in the middle of October. But if this chart completely falls apart upon itself and it starts rolling over to the downside for whatever reason, this is a defined risk trade. The most you can lose is the amount that you put into it. You can't lose more and more as it continues to slip further and further. So anyway, it's one of those kind of 1-for-1 reward risk trades on a chart that is giving us a nice bounce in the midst of a pretty ugly selling session for the rest of the market. Okay, so that's what I had for you here this evening. Thanks for stopping by and checking out the video. If you got any benefit out of the video, I have one simple request for you. Take the 5 seconds out of your day to click like for us there on X/Twitter. Remember, there's 4 different ways to go about that process. As long as we're up and over 100 likes by the time I'm scheduled to do the video again on Thursday, I'll be happy to give you another hour-long video. On the other hand, if you think these are getting a little bit long in the tooth, that's all right as well. If it's under 100 likes, we'll plan on keeping it short and simple with just a 15-minute quick hitter type of a video there. So we'll let you guys decide, but whatever it is that you do decide, thank you so much for stopping by, checking out the video here this evening. Hope you guys have a great rest of the night. Best of success with your trades and your investments. Goodbye for now.